So, yeah, this has actually worked out pretty well with having Dick doing a lead-in on what we're talking about, and I'm taking things to a little different level than actually actually driving to a individual benchmark and doing some comparison, and I want to talk about that and combine that with Dick's observations. But what we do and what we've been doing now for 17 years on the swine side and probably about 10 years now on the cropping side is produce this comparative benchmark. And, you know, what this slide basically says this is what this is. It is a confidential peer group. It's not a contest. Nobody knows whose numbers are whose. It's completely based on managerial accounting, and as Dick laid out earlier, it's got to be based on accrual financials. Dick even mentioned the fact that you don't worry about being perfect to be able to get some value out of it. I mean, I tend to tell people that, okay, we don't have everything exactly nailed down, but 90% of the way is better than 100% of nothing. And as I repeat there again, it ties to the accrual information. Dick talked about the dangers of benchmarking at individual line items. And that to me, that would be things like seed costs. Comparing the seed costs of farm 1 to farm 2 can be very challenging. You know, one could have stacked genes, the other could be you know, more a cheaper cost of corn, and they could be adjusting some other ways. You could have Roundup ready crop in which you're using chemicals and a higher cost seed potentially. So, you know, I agree 100% with him that comparing seed costs across farms might be challenging. But the way we learned to do this on the swine side, and which is how we've adapted it to the cropping side, is to group costs into categories. And as it shows here, taking seed, fertilizer, and chemicals and combining those into input costs. And taking land costs, which would be property taxes, land interest, land rent, irrigation costs, and combining those costs all together into something we're calling land costs. And on the equipment, taking labor, fuel, machine costs, and coming up with a category called operations cost. Now, Dick talked about the essential thing of recognizing really what is trying to identify what is your profit center and where's your cost centers at. And in some cases, you've got revenue. Now, custom work is a really good example of revenue. And the way I treat custom work in the analysis that we use here is as a cost reducer, which you'll see on a couple of instances coming up here. So this is just kind of a restatement of this, and this is all pretty critical, whether you're doing this like in our comparative, or if you're just doing it for yourself year to year, you need to be pretty consistent. So when you're looking at your costs from year to year, that they are grouping your costs together in a normalized way, which allows you to look at stuff comparatively. So here I said net land cost is the total of cash rents, interest payments for land, landlord crop share operations costs, which is fairly evolved, but actually not that hard to do. Conservation cost, and I give credit, and I could probably get argued with this, but I give credit for government program payments, and irrigation costs are on top of that. Now, the government program payments are more confusing now than they used to be when they were kind of tied to the land and they were often bid into the land cost. But that's an issue you just need to be aware of. Operations costs are a sum of labor, fuel, and machine cost as well as other normal credit and cost reducers. And what we're trying to do here is get the category to be comparative, even though the individual line items may not be. So on the screen here is a grouping of from a number of our clients at Latta Harris, and we try to display the number by the farm code. So if you were in the participating in this, you would know what your code was, but that's all you would know. And we have identified, then you look at, say, look at the category of seed. You go from $78 to $141. That's Dick's Point. Same thing with the fertilizer costs, huge range, chemical costs, large range. And then you get to the category, which is the total input costs. And I have been surprised at how well, when we start looking at the categories, you do become comparative. Now, also another critical thing, and I've identified one of these farms, which is not Iowa or Illinois. So if you get too far afield and you start to be too broad in your comparisons, then you do start to run into some real questions and differences. I feel like the data set here is really from a relatively, probably within 250, 300 miles of Des Moines. It is an area that has a very similar cropping type history, and so I feel that we have some validity in doing comparative. I also really try to look at in that gold bar, Iowa State's, kind of what they estimated the cost were going to be, and then the purple bar is University of Illinois reports on Northern Illinois, what they actually recorded as their actual cost numbers. And to do that, then it allows me then to kind of, what it does for us, what it does for me as a consultant, and what it does for our other accountants in Latta Harris, is when we sit down and work with a client's financial data, and we can get it into this comparative format, take their numbers and put it in there, it really starts to help us understand by cost category and even down to line item. Line item, again, is more important just farm to farm, year to year. But the cost category, you start to look at like that one in the middle there that has an input cost of 423. There's a relatively low land cost, which probably means they're a little smaller operation, but they have most of their land paid for. But they have got an issue. Somehow you'd have to ask them the question, why are you spending so much money on your inputs? You know, I would say, you know, over the years it varies, but you know, you look at 275 to 350 is kind of the range of input costs. You start to see something either quite a bit below that or quite a bit above that. It really prompts questions about, okay, what's the explanation for that? And if there isn't a solid explanation that there's, you know, they're doing some kind of seed activity or something special that's driving those cost differences, then you'd have to start to think about, well, maybe what if your costs are on the high side, maybe you've got opportunity there to improve your net bottom line. Take a look at land costs too, and another reason they separate out in categories is people say, well, how can you do a comparative benchmark? Because some people have very low land costs, some people have very high land costs. Fine, you can go through this calculation, and you can go through and you can set everybody's land cost to identical number, 250 an acre, or whatever you want it to be, and then you can still see what it does to their total cost. So by doing that, you can pick and choose how you do your comparison and be able to get yourself into more comparative number. Another thing that we have found and that we have used to really good effect working with individual clients is you take this same information. Now this is based on actual 2019 production, but you take this. I guess I'm not showing my screen, but anyway, you take this and you turn it into the budgeted number. You put it into the same category, and hang on a second. I'll start my video, and it turned off. you do it from a budgeted basis too, and then you can start looking at your budget comparison to your multi-years actuals if you've been doing this a while, and then you can start to tell whether your budget looks consistent with what your normal performance is. Again, by breaking it down into categories, it gives you some way to manage the numbers. We'll look at the Mo's information coming up here, which is on actually in the same kind of process, but instead of by crop, it's by farm, and it's per acre. And it's you come up with a different number because it's the way they do things. It's more forward looking, and they're looking at stuff from a risk management standpoint. While here we're trying to identify where opportunities might be. And the reality, even under like total machine costs, and I haven't shown every one of the line items here, but you have book depreciation, and Dick talked about that how critical a good depreciation methodology is, not to use just tax depreciation. That really is very, as you all should know, is not very accurate. Mo will talk a little bit. They do some stuff utilizing a percentage, a standard percentage system year over year, and at least it's consistent. And a good book depreciation schedule can really, if you learn how to manage that, can really tell you pretty well if you are really tracking your depreciation costs or not. We then as we go across the screen, we just keep rolling up those costs. And I come up with a category I called cost production before storage, G&A, and crop insurance. And again, back to Dick's observations, is that if you look purely only at line item, you can get a lot of variation. So if you go over to the right and you look at crop insurance, you got $3 to $33, and that's really a risk management decision potentially, and maybe somewhat due to the location from a crop insurance standpoint. And G&A and drying costs can vary an awful lot. Some people really, take most of their crop to town, and so they don't really ever recognize in the drying cost except in the reduction to their revenue. So it really varies. So I have decided, and the way I've laid this out is really the most comparative number, and that's the number we've sorted there, is cost before drying, G&A, and crop insurance. So the concept here is to try to give as comparative as you can if you're doing benchmarking between operations. Go ahead and we put those other costs that have been identified by that operation ending up there on the right in the total cost production per bushel. We then, in this case, and this is something I learned from working with Mo and his group, is they do a projected profit per bushel based on an assumed market price, putting everybody on the same category. And you can see what happened in 2019 to this group of operations as far as what with that 358 a bushel. I got a misprint there in the category, is a lot of red ink showing up. So this same thing, same step, same process on the soybean acres, same idea. And what I would strongly encourage is that building a process, getting some kind of comparative system. And if you think about even a conventional, one of your farms might well vary your methodology from year to year. And so again, if you look at your comparative numbers at more of a category-like basis, potentially you changed your chemical program, or maybe you change your seed program in conjunction with that, so that over years you could really start to compare more on your input costs and what's happening to them year over year. We now have enough data on the swine side and also on the crop side, and we've used it both ways. We're able to drop in all this data, and on the swine side, we're able to go in and drop in 10, 15 years worth of data. And we've also defined the benchmarks and the same thing over that same 10 or 15 years. And then we're able to start looking at trend lines, trend line performance in an operation over time, and compare them to how their peers were doing, the averages of the group, and how their trend line is against maybe an average or a peer group. So, Norm, is Mo with us?
Looks like he is. Mo, can you hear us?
Yes, I can hear you.
Okay, so we're about ready to run into Mo's group, which they reported that these are the numbers that they used for their planning prices for 2020. So while the data that I just showed was from 2019, now the data that Mo's group has worked with is for 2020. And it is a process, and Mo, you may want to explain that and why you do it the way you do, and that's your planning price. So Mo, I'll turn it over to you.
Okay, yes. You can see the numbers there on the screen. It's about half of the operations projected a profit at 365 corn and 870 beans. The other half projected a loss. So that average is probably pretty close to average cost of production. And what we do is we use last year's actual as a benchmark and project any changes for 2020 expenses. So if fertilizer went down slightly or went up slightly, we project that in. And the reason we do that is we then have a gross dollars per acre goal that we use for making marketing decisions.
Yeah, because these are corn and bean acres combined. Right?
Pardon?
These are corn and soybean acres. These are kind of whole farm. Cost per acre, crop acre. They're not individual crops. They're not corn or soybean.
No, it's corn and soybeans. Total acres 42,000.
Yep.
And the average projects, you can't quite see it on the computer, but on my printout here, the average projected a $7 per acre loss at 365 corn and 870 beans. Later on, I'll share with you our benchmarking data. That's actual financial data off of clients' balance sheets and income statements, and it's very interesting to look at the trends. Lot of variation between individual producers, as you can see.
And Mo, would you say that's been I see that on the individual crops, corn or beans, and you've seen that on the combined, still a huge amount of variation in cost in operations, which should be relatively similar. They're from the same kind of area.
Yes, these are primarily Corn Belt.
And you see the ones over on the left that are flagged in purple with the 8 range size. They're not Iowa or Illinois, but they would be adjacent states.
Yes.
Nebraska.
Just look at the variation in seed costs, the second column, from 127 per acre to 62, 59. What we encourage producers to do is is look at your numbers, compare them to an average, and then drill down and do a more thorough analysis and explain to yourself, and a lot of these costs are justifiables, but then explain why there is the variation there is. May be a good reason, may not be a good reason.
So Mo, I have your 19 numbers. Those are from the last year. And then I just have here, I have that year over year comparison. And then just the percent change year over year. Which I was a little bit surprised to see land costs actually creeping up a little bit in that time frame.
Yes, $3 an acre.
Yep.
Fertilizer and chemicals went down slightly.
Yep, 97% for input costs. Operations down somewhat, 91% of prior year, 166 versus 182. Total crop expenses, really not much change, but revenue, your projected revenue, your budgeting revenue was certainly down.
Yes.
Which the combination of those two things would be a greater loss, estimated loss on average.
Yes.
And Mo, I've also got on here those other two slide sets, if you want me to show any of those.
Great. Yes. If you could bring those up, John, I have a few comments on those.
Okay, hang on a second. I gotta get myself back to where I need to be. That's the current period, and I have the older period. Which one do you want?
Let's start with the current period.
All right, are you seeing it?
Yes or no? I see a lot of hair offices.
Okay. What are you seeing, Nora? Are you seeing the eggs?
Same thing. I'm seeing the lot of Harris offices, like the last slide in the deck or something like that.
I got to get it to show a different screen, I guess.
Yeah.
That matter?
No,
No?
not yet.
All right. It's a combination jumping back and forth between the systems here. I've got to, oh, it paused it, okay. Better?
Yep.
There it is.
Yeah.
There it is. There's a 5-year average of machinery cost per acre from our client base. And as John mentioned earlier in his presentation, we use a consistent method for the last 10 years, and we'll share the previous 5 years in a moment. But we use a consistent formula for determining machinery cost per acre. What we do is we take market value of equipment used in crop production. So if there's livestock equipment in the machinery list, we remove them. We'll only use that equipment used in crop production. And then we take market value of that equipment and multiply it by 25%. And that's the 132.05 figure you see there per acre. That 25% consists of 10% interest or opportunity cost. Even if the line of equipment's paid for, we feel there's a 10% opportunity cost of your capital. And then we use 10% depreciation and 5% repairs. So we have used that same 25% formula for 10 years. And parenthetically, 10 years ago, that 132.05 figure was $89.46. The labor cost per acre, the way we calculate that is we use operator draw from the operation and crop operation and add hired labor and divide it by harvested acres. There's a lot of variation. I can think of one client whose spouse is a pharmacist at Walmart, and they don't take anything out of the crop operation to live. And that, so that's all rolled up in those figures. But our point is, it is what it is. And then we look at the combination of those two figures. 132.05 machinery cost per acre and labor cost per acre 48.48 equals $180.53. 10 years ago, that figure was $134.94. Individually, machinery cost per acre, I mentioned 132. 10 years ago, it was 89. Labor cost per acre, 48.48. 10 years ago, that was 45.48. And it has not varied any more than about $3 an acre for the last 10 years. That's really interesting. What that tells me is that the industry is using larger, more sophisticated equipment, which takes less labor. And I think that's good. The combination of labor and equipment this year is 180.53, and 10 years ago it was 134.94.
So they substituted quite a bit of equipment for labor.
Yes.
Right. Total cost has gone up, but it's been heavier on the machine side than the people side. Yeah.
Yeah. Return on assets kind of surprised us. We thought it would drop from the previous year. It went up slightly, and return on equity went up slightly. As we reviewed financial statements this winter, it's pretty obvious the positive impact of market facilitation payments in these operations. And the average operation is still profitable. The next slide looks at working capital divided by annual expenses. That's the dollar amount of working capital, current assets minus current liabilities, divided by annual expenses. 10 years ago, that figure was 58%. Today it's 28%. So the last 3 years have been the largest drop in working capital, both per acre and on a expense base, percentage basis. We really need a couple good years in the next 4 or 5 years, because it's been tough. And the percent owner's equity average dropped below 60% for the first time in 10 years.
And that's on a market value basis, right?
Yes. just to share some previous years, 2011, 12, and 13, the return on equity, you might back up that slide, John. Return on equity, I think it was 4.8.
4.6.
4.6. In 2011, the average return on equity was 20%. In 2012, 21%. And in 2013, almost 18%. If you recall, those were the years of $5, $6, $7 corn, maybe even $8. And what we've experienced the last 3 years, you know what those prices have been at. So it's, like I said, we need a couple real profitable years in production agriculture. That working capital per annual expense at 29%. 25% is red light in our analysis. So it's, and 50% is green light. So it's in 3 years went from almost green light to almost red light. So that's a pretty significant drop. However, we still are really proud of our client base and our portfolio. I heard the Chief Credit Officer of Farm Credit Services speak a year ago this month. And 10 years ago, their data looked about like ours did, but now their working capital to gross revenue rather than annual expense on average is 14%. So if 14% is the average, they got to have a lot of operations with negative working capital. So there again, production agriculture needs some more profitable years.
So Mo, Mo was never introduced to really here. Mo, you might want to mention on the change of your logo there.
Yes. We changed the name several months ago from Russell Consulting Group to Ag Shurian. It's a result of several things. First of all, CHS Hedging had owned Russell Consulting Group in its entirety since April of 2016. And then I worked for them for 3 years on contract, and now I'm still working as an associate, handling clients on a commission basis. The sale worked very well for me, and I'm very happy for it, and things have gone real well. But they wanted to rebrand the name Russell Consulting Group and call it Ag Shurian. That's okay with me. I don't have any problem with that. Quite frankly, from a liability standpoint, it's probably okay not to have my name on the company anymore. But yeah, that's the rebranding that has taken place. But we're still very excited about the opportunities in production agriculture, not only grain production, but the livestock business, cattle, hogs, poultry, and dairy. But as John pointed out in the data he shared and our data, there's a wide variability in productivity, production, and cost. And so if you can get in the top third or top 20% of the producers in America, there's a tremendous amount of wealth to be created and a lot of fun to be had.
So Mo, what's your thought about consolidation? I remember back 15, 20 years ago in the hog industry, we were seeing huge variation between operations, which led itself into a fairly strong consolidation phase. Where do you think the crop side is at this point? Because we are still seeing that same kind of variation out there now.
Yes, and I think it's going to continue. I was just amazed. I was just looking at some farm magazines before I got on the call. The size of equipment. I mean, John Deere now has a Series X combine that'll harvest 7,200 bushels of corn per hour. That's 7 semi-loads in an hour. That's a semi-load of corn every 8 minutes. I just can't believe, and somebody's going to be buying those. And so I think the consolidation in the crop production industry is going to continue much like it did in the hog industry, as John mentioned. I think I see the consolidation in the hog industry slowing down.
I would agree.
But I don't think it's going to slow down in the crop production side for some of the reasons I mentioned earlier in my comments. The technology and sophistication and size of farm equipment today is just unbelievable, and labor in most operations is harder to find, and so I think you're going to continue to see that consolidation.
Well, thank you, Mo and John. You have anything else, or does anyone have any questions for either one of them? And I'm sorry, in the transition, I didn't introduce either one of you, but Mo Russell, who founder of Russell Consulting and Group, and John McNutt, who's a longtime consultant with Latta Harris CPA firm, and both doing excellent work. Do you guys have anything to add, or do we have any questions before we move to our last session?
Yeah,
I don't have anything.
Norm, I'll get back to the screen here. I just want to share.
Okay, you're in the driver's seat.
I got to get, trying to find it back here. Come on. So there we go. So traditionally we've done the tomorrow on Wednesday I've presented the pork cost production benchmarking standards report, and not doing that this year with the COVID issues that are going on. But I just wanted to let you all know, any of you who are interested, that is prepared and available. And so if somebody would like to get that, please, I have my email on the screen here, jmcnutt@lattaharris.com, or through Norm or whatever, let me know and I'll send you a copy. It's 40 pages. So, and there's the benchmarks, 50th and 90th. And again, we've done that for 17 years, and interesting there, seeing some changes in costs. Year over year, feed costs are up. Labor is up quite a bit on the swine side. So just wanted to share that with you before I'm done.